Today we're doing a complete breakdown of ASC 805. We'll cover the scope, core principles, measurement, journal entries, and real interview questions. Whether you're studying ASC, prepping for a Big Four interview, or working in finance, this is everything you need to know. Before ASC 805, companies faced chaos in accounting for mergers and acquisitions. With transactions reaching billions, clarity was essential. ASC 805 standardizes how acquisitions are reported, ensuring transparency and consistency. After this section, you'll grasp the significance of ASC 805 and how it transformed financial reporting for business combinations. ASC 805 was developed to solve the inconsistencies plaguing merger and acquisition accounting. Companies were reporting transactions differently, creating confusion. By standardizing the recognition and measurement of acquired assets and liabilities, ASC 805 ensures everyone speaks the same language. Using fair value, it paints a transparent picture of what a company truly gains or owes after an acquisition. ASC 805 is mandatory for any entity involved in business combinations and has been in effect since late 2008. Its cornerstone is the acquisition method, demanding that firms recognize acquired assets and assumed liabilities at fair value. This requirement ensures transparency, allowing stakeholders to truly understand a company's financial health post-acquisition. Whether you're a small startup or a global conglomerate, ASC 805 guides your reporting. The acquisition method is the heart of ASC 805. It treats all business combinations as purchases, ensuring identifiable assets and liabilities are recognized and measured properly. This approach prevents firms from masking poor performance through creative accounting. Goodwill or a gain from a bargain purchase emerges from these measurements, providing clear insight into the deal's value. For interviewees, understanding this is crucial as it ensures clarity and consistency in financial reporting. Scope is crucial because missing exclusions is a typical mistake. Candidates forget that transactions not covered by ASC 805, like asset acquisitions, can trip them up in interviews. Misidentifying these can lead to incorrect accounting treatments and affect financial reports. Understanding scope is like having a roadmap. It guides which transactions require ASC 805 application and ensures compliance. ASC 805 is pivotal for acquisitions, ensuring business combinations are reported at fair value. For instance, when a company acquires another, assets and liabilities must be measured accurately. Joint ventures and transactions within a corporate group are also crucial examples where this standard applies. Understanding these inclusions ensures you apply ASC 805 correctly, avoiding potential reporting pitfalls. Understanding exclusions is essential because ASC 805 doesn't cover asset acquisitions that lack a business structure. For example, buying a building without associated operations falls outside its realm. Similarly, forming a joint venture is not covered, nor are transactions between entities under common control. These exclusions require different accounting treatments, often leading to confusion and errors if not carefully considered. In mergers, the acquirer is crucial. It's the entity that gains control over the acquiree. Consider when a tech giant acquires a startup. The giant is the acquirer. This role determines consolidation and future reporting. Identifying the correct acquirer avoids missteps in financial statements, ensuring accurate representation of post-acquisition scenarios and aligning with ASC 805 requirements. The acquiree is the business being acquired, essential to understand for fair value measurement of assets and liabilities. For instance, when a larger company buys a smaller one, the acquiree's financials become part of the acquirer's reports. This transition affects reporting structure and operational control, making it vital to recognize all components accurately. Misidentifying the acquiree can lead to significant reporting errors. Scope edge cases challenge understanding. Take a division purchase. It's not a legal entity, so ASC 805 might not apply. Or consider acquiring assets without processes. Here, it might not qualify as a business. Buying shares sans control doesn't necessitate ASC 805. Intra-group transfers without control change aren't covered either. Recognizing these scenarios is key to applying the standard correctly and avoiding missteps. When a company acquires another, ASC 805 ensures clarity and consistency. Imagine acquiring a competitor and needing to account for their assets, liabilities, and goodwill. This method offers a roadmap for such transactions, ensuring everyone speaks the same accounting language, tracking every dollar, from initial identification to final consolidation. This method transforms chaos into clarity. Through 4 structured steps, it dictates how business combinations should appear in financial statements. For our example, Meridian Corporation's $10 million SaaS deal with Acme Incorporated will illustrate these steps, showing how we identify, record, and measure each element, ensuring transparency and comparability. Identifying the acquirer sets the stage for the rest of the acquisition process. In our scenario, Meridian Corporation gains control over Acme Incorporated software and services, positioning Meridian as the acquirer. A frequent pitfall is assuming ownership percentage equals control, but ASC emphasizes actual power over the entity's decisions. With this understanding, we proceed to set the acquisition date, the next pivotal step. Pinpointing the acquisition date is crucial for accurate financial reporting. In the Meridian Corporation scenario, the acquisition date is when they gain control, not necessarily when the contract is signed. This distinction affects everything from revenue recognition to liability assumptions. Many err by using the signing date, but ASC stresses the importance of when control actually transfers. Next, we'll dive into recognizing and measuring the acquired assets and liabilities. Recognizing and measuring each asset and liability ensures a true reflection of the acquisition's value. For Meridian Corporation, this involves accounting for Acme's $8 million software and $2 million services. A common oversight is ignoring contingent liabilities, but ASC insists on capturing all, including these potential future costs. With assets and liabilities now recorded, we turn to calculating goodwill or recognizing a bargain purchase. Goodwill reflects the premium paid over an entity's tangible and identifiable assets. Meridian Corporation's purchase cost of $10 million is compared to Acme's net assets fair value. Excluding any liabilities or assets can lead to significant errors in goodwill calculation. ASC ensures accurate reflection by mandating inclusion of all recognized items. With goodwill now determined, Meridian's acquisition process under ASC 805 is complete, providing a clear financial picture. The measurement method you choose directly impacts your balance sheet. A wrong choice can overstate assets by millions. ASC 805 sets precise rules for recognizing and measuring business combinations, ensuring companies report assets and liabilities accurately. Proper disclosure is crucial for stakeholders to truly understand a company's financial position. When a company acquires another, ASC 805 mandates that all identifiable assets and liabilities are recognized on the acquisition date. They're initially measured at fair value, ensuring that the balance sheet accurately reflects what the company paid. Special attention is given to contingent considerations, which require a calculated fair value estimation. This influences the overall consideration paid and ultimately impacts future financial results. After acquisition, ASC 805 requires ongoing measurement of acquired assets. For example, intangible assets like goodwill undergo annual impairment tests instead of amortization. If the fair value changes, assets are remeasured, which can notably affect earnings. Contingent consideration is particularly dynamic, impacting the financial statements when estimates change. Depreciation or amortization applies to tangible assets, spreading their cost over useful life, offering a clear view of asset utility. ASC 805 ensures transparency in financial statements by requiring specific presentation. Intangible assets such as trademarks are shown separately, while goodwill appears under non-current assets. Immediate expensing of acquisition-related costs impacts the profit and loss, reflecting the true cost of acquisition. Detailed notes provide vital context, disclosing the fair value of acquired assets and assumed liabilities, aiding stakeholders in understanding the true impact of the business combination. Robust disclosure under ASC 805 is crucial for accurate financial analysis. Companies must disclose the fair value of acquired assets, providing insight into acquisition impacts. Details on contingent consideration are vital, as they highlight potential future liabilities. Transparency around asset valuation rationale aids in assessing management's judgment. A goodwill reconciliation tracks changes over time, helping analysts evaluate impairment risk. These disclosures collectively enhance stakeholders' understanding of the acquisition's financial consequences. Imagine TechCorp's CFO acquiring a startup for $10 million, with $2 million recorded as goodwill. The immediate expensing of $500,000 acquisition costs affects net profit, while a $200,000 goodwill write-down from annual impairment tests impacts earnings. Disclosure of a $3 million contingent consideration becomes essential, outlining potential future cash outflows. This practical scenario underlines how ASC 805's measurement and disclosure requirements shape financial reporting and decision-making. Meridian Corporation, a global manufacturing company, acquires a smaller competitor for $25 million. Discover how this acquisition transforms their balance sheets under ASC 805. From initial recognition to final derecognition, follow each step to see the financial impact unfold. Meridian Corporation records the acquisition of a competitor by debiting investment in subsidiary and crediting cash for $25 million. ASC 805 mandates recognizing the fair value of acquired assets and liabilities at the acquisition date. This entry reflects the initial investment and cash outflow, impacting Meridian's liquidity and asset portfolio. The allocation of the purchase price to machinery and equipment reflects the fair value of these tangible assets at $10 million. ASC 805 requires an allocation based on the fair value of identifiable assets. This transfer reduces the investment in subsidiary while increasing asset accounts, thus refining the balance sheet presentation. Recognizing intangible assets like patents at $5 million underscores the strategic value within the acquisition. Under ASC 805, intangible assets are separately identifiable and valued. This step reduces the investment in subsidiary account, enhancing transparency and recognizing the intangible benefits of the acquisition, critical for future earnings potential. Goodwill represents the premium paid over identifiable asset values, recorded at $10 million. ASC 805 requires this recognition when purchase consideration exceeds net identifiable assets. Goodwill captures synergies, brand value, and growth potential. It is a key non-current asset, affecting future impairment tests and providing insight into strategic acquisition benefits. Amortizing intangible assets spreads their cost over their useful life, reducing the book value annually. This $500,000 annual amortization, as per ASC 805, impacts net income by recognizing asset consumption. It reflects prudent financial management and ensures the balance sheet depicts assets accurately over time, while affecting profitability. An annual goodwill impairment test ensures the carrying amount does not exceed recoverable value. A $1 million impairment reflects reduced anticipated synergies or market changes. ASC 805 mandates this to maintain asset accuracy. The impairment hits the income statement, reducing reported profits and highlighting changes in business valuation assumptions. Finalizing acquisition accounting involves adjusting for assumed liabilities at $2 million. Completing the allocation process under ASC 805. This ensures all asset and liability values reflect fair market conditions. The adjustment impacts the balance sheet, refining investment and liability portrayals, and ensuring the acquisition's financial aftermath is fully recognized. Selling the subsidiary for $30 million and derecognizing related assets and liabilities conclude Meridian's acquisition journey. The investment is cleared from the books, and an $8 million gain highlights the transaction's success. ASC 805 ensures the gain accurately reflects the financial outcome, signaling strategic execution and enhancing shareholder value through an increased cash position. Every Big Four and investment bank interview on ASC 805 follows a pattern. Here are the 10 questions that come up again and again, with answers that will make your interviewer nod. The acquisition method is the standard approach for business combinations under ASC 805. It requires identifying the acquirer, measuring consideration, and recognizing assets acquired and liabilities assumed. A common mistake is confusing it with the pooling of interests method, which isn't allowed under ASC 805. Remember, the acquirer recognizes goodwill or a gain from a bargain purchase. ASC 805 was implemented to provide a consistent framework for accounting for business combinations. It ensures transparency and comparability across financial statements by requiring the acquisition method. A key point is recognizing all identifiable assets and liabilities at fair value. Avoid assuming it's optional or similar to older methods. Contingent consideration is included at fair value at the acquisition date, impacting the total consideration transferred. ASC 805 requires subsequent measurements at fair value through profit or loss. Companies often mistake only considering initial cash payments. Remember, changes affect earnings, not just goodwill. ASC 805 requires companies to recognize assets acquired and liabilities assumed at fair value. Goodwill is recorded if the consideration exceeds net assets. Companies often overlook disclosure requirements, which include detailed notes on the acquisition. Emphasize the importance of transparency and comparability. Ensure that all financial impacts are comprehensively reported. While both ASC 805 and International Financial Reporting Standards 3 use the acquisition method, differences exist, like the treatment of contingent consideration and measurement periods. ASC 805 may require revaluation through profit or loss, whereas International Financial Reporting Standards 3 can adjust goodwill. Don't assume identical standards. Differences impact the financial outcomes. When acquiring a company for $10 million, with net identifiable assets of $8 million, record goodwill of $2 million. Debit assets, credit liabilities, and credit cash for the payment. A common trap is miscalculating goodwill. Always verify the fair value adjustments and ensure proper recognition of all components. ASC 805 excludes transactions like joint ventures, asset acquisitions, and not-for-profit combinations, which use different accounting standards. Misclassification often occurs with asset acquisitions, mistakenly applying business combination rules. Understand that these exclusions require specific treatment. Recognizing the correct scope is vital to avoid serious reporting errors and compliance issues. Disclosures under ASC 805 include information on the acquisition date, primary reasons for the business combination, and qualitative and quantitative aspects like revenue and profit contributions. A common mistake is inadequate detail, leaving stakeholders uninformed. Remember, thorough disclosures enhance transparency and support investor confidence in financial statements. Non-controlling interest is measured at fair value, or proportionate share of net assets. The tricky part is aligning it with the acquirer's interest while avoiding undervaluation. Misunderstanding can skew consolidated financials. Always check measurement basis and reassess if control changes. Accuracy in this area is critical for reliability. ASC 805 lets us peel back the layers of business combinations. We find clarity in defining a business, recognizing the acquirer, and measuring identifiable assets. Goodwill emerges when purchase price exceeds fair value, and non-controlling interest reflects minority shareholders. Understanding the scope of ASC 805 and the objective of clearer reporting helps us interpret complex corporate moves. Grasp these basics and the ASC 805 landscape becomes navigable. Unveiling the acquisition method. It's the cornerstone of ASC 805. Identifying the acquirer is crucial and sets the stage for recognizing all identifiable assets at fair value. Goodwill, often scrutinized, represents the premium paid over net assets. Contingent consideration requires fair value assessment, while the measurement period allows for fair value adjustments. Bargain purchases, though rare, show up as earnings gains. Precision in these elements defines compliance. In interviews, understanding ASC 805 nuances can set you apart. Control determination is pivotal for identifying acquirers. Be aware of goodwill impairment risks and ASC versus International Financial Reporting Standards differences, particularly in disclosures. Measurement period adjustments must be precise, and contingent liabilities need careful evaluation. Distinguishing provisional from final valuations is critical, as is grasping earnouts based on performance. Master these concepts to demonstrate depth and precision. That's your complete guide to this accounting standard. If this video helped you, please like and share. It genuinely helps us keep creating content like this. Drop your standard requests in the comments. Subscribe to Candy Mentor for more accounting and finance videos. We'll see you in the next one.